Okay, Wednesday night, March the 11th. And in this video, I'd like to go over an oil trade, or a couple of them, that I started on March the 9th. Quick recap, if we take a peek at a chart, we can see that Sunday, March the 8th, there was quite a stir in the markets. The eminis were down quite a bit. At one point, I think down 130, and oil was rallying, and it looked like it was going to go to 200. But it didn't go quite that high. It got up to 113.41. This was at 7:30 in the evening. That was the high. Was the high point, and then it had an incredible drop all the way down to 79. So 34 and a half ish, 34 and change, 34.41. That's a big drop. Almost 30% off the top of my head. Close. It's got to be 28, 29%. So anyway, at this point, Sunday night, I was looking to sell broken wing butterflies up above, somewhere around here. And I didn't find, I couldn't get filled on various orders. I was working between 15 and 20 cents in the April contract, which I believe expires on the 16th. Is that right? I was looking at April 16th, 36 days away. Could not get filled. So what I did was I sold a put spread the following morning. This is March the 9th at almost 7:30 a.m. Pacific time, mind you. And I did this for a 35-cent credit. And let's see where May crude was trading at the time I did the trade. So 7:26 a.m. March the 9th. Let's see what we have here. So it's probably around one bar over, somewhere between 99 and 95. And it ended up going all the way down to 79. But anyway, when it was in the, let's just call it 97-ish area, I sold a 79.78 put spread for 35 cents. The multiplier in crude is $1,000. So I received $350 to take this risk. Note that on this particular trade, the downside risk is a breach of 78. So if this were to close at 78 or lower, then that would be $1,000 loss, and that's 79 minus 78, which is 1 times the multiplier of 1,000, minus the credit of $350 I received. So I have $650 of risk to the downside. Now this evening, which is March the 11th, I was pricing out some broken wing butterflies up above, and I could not get filled on orders that I was working. So what I decided to do instead is to use some of the credit from the 79.78 put spread, which, let's look at an analysis tab here. Let me isolate the 79.78. So what I was looking to do, or what I decided to do, was is use the credit of 350, so to speak, and give myself some coverage to the downside via a butterfly, a slightly broken wing butterfly. Now, one of the reasons I want to do, or I was interested in providing myself some coverage to the downside, with a particular structure, which I'll show in a minute, is that the market is currently, let me use this should be good enough. Let me use the 91 strike line as the main strike line. So if you look at a put spread from 91 to 81, it's going to cost roughly what, 50, 60, let's see what we have here. Okay, so $6, let's just call it 6 1/4. So what this is saying is that the odds of the market closing the halfway point, which in this case would be 86, is basically around 63%. All right, now let's take a look at call verticals, and we're going to buy 91, and I'm going to go $10 higher to the 101, and this is going to be what, maybe 250, okay, 270. So what this is saying is that there's going to be there's roughly, and this is a simplification, a 27% chance that the market closes in between 91 and 101, which would be 96. So a 27% odds of it closing 96, and let's call it 63-ish that it closes at 86. All right. So more than 2 to 1, the market's saying more than 2 to 1, that's probably going to go lower. That's one way of quickly scanning the odds via the options chain and what those odds are saying. So that being said, I wanted to provide a little protection to the downside, and what I did, I haven't used this in a while, back on Tasty for some trades, but here. All right, so what I did was I bought a slightly broken wing butterfly, same expiry, April 16th, bought an 80, sold 275s, and bought one at 69, and this was done for a 17-cent debit. So note that the net of credits and debits is 18 to the credit side. So I used some of this credit to make a somewhat defensive move to the downside, but this isn't completely defensive, and the reason why is because if we look at back at the analysis tab, now when we piece everything together, I have coverage to the downside. Remember, when I had the put spread, the 79.78, I have $650 of risk to the downside. But now, if we look at the total structure, I have no upside risk and $180 credit. All right, cool, good for me. Between 79 and 78, I can make $1,180, and the apex of this trade is at the 75 strike line, and there I can make $4,180. Okay, downside risk. Now that has increased from the original 650 to now $1,820. But rather than the downside risks being at 78, now I pushed it way down to under 71. So I have roughly a $20 cushion. I have an interesting profit tent here with the apex at 75. So the pin and tail on the donkey on this trade is worth $4,100 ish, and to the upside, I have no risk and $180 winner. Will crude oil go down? I don't know. Will it go up? I don't know. I don't particularly care, but obviously I would prefer that it doesn't get crushed between now and the April 16th expiry. If I get lucky, then maybe this prices will trickle down, and at expiration I'll be able to pin the tail on the donkey here, or end up somewhere interesting between 79 and 75. And again, I have no idea if it's going to go down there or not, but with this current setup, my risk is to the downside below 71, and nice apex here at 75, no upside risk, and this complete setup was done for an 18-cent credit, which, given the multiplier of 1,000, is $180 credit. Yeah, I thought that was kind of interesting. We'll see how this plays out. Currently, we can see that the eminis are down $56 in the overnight session, and crude is up a touch with May currently trading just under $92. All right, we'll see how this turns out. Thank you for tuning in. Good luck trading, and I'll catch you guys next time.